Let's calculate the stock price for Verizon. First, we need the market cap, 234.8 billion, and then the stock price, 56.76. Now we know the shares outstanding. It's the market cap divided by the stock price. That gives you the shares outstanding. And the way to calculate the value of a company is to estimate the future free cash flows and then discount that number back to today's value. And that gives you the value of the entire company. And then you take that value and divide it by the shares outstanding. And that gives you the intrinsic stock price and way to compare it to the actual stock price to see if it's higher or lower. Now we need the actual free cash flows for the company, and that's in Yahoo Finance. In the financial section, go to cash flows, and then on the bottom has free cash flow. And this is the cash that's remaining after operating the business for a year. So it's the best indicator for the companies. Next is net income, and that's the profit and loss for a given time period, and that's in the income statement. And last is revenue, which is also in the income statement. So the free cash flow seems like it's been increasing, which is a good sign. Net income jumped a lot from 16 to 17, but then dropped. I'm not exactly sure. We can look into that, but it's probably some accounting or depreciation, or maybe they took a loss or something in the past. A lot of things can affect net income. And revenue is pretty smooth as it usually is. It's been growing each year. Next, we need to look at the capital structure of Verizon to figure out the discount rate we need to apply to the future cash flows. So the interest expense is the interest they pay on their debt, which is 4.7 billion. Let's see how much debt they have. We'll go to the balance sheet and then the liabilities. And current debt is 10 billion, that's due within 12 months. And long-term debt is 100 million, and that's due after 12 months. So they have a good amount of debt, over $100 billion of debt. Interest payments on the debt are tax deductible. So let's find out their effective tax rate. So the income before tax is 22 billion and the income tax is 3 billion. So the effective tax rate is 13%. So the cost of debt is 3.7%. And you can see they have 32% of the capital structure is debt, which is a little bit high. Not too bad. As long as it's under 50%, it's okay, but you still want a little less debt. Now we need a cost of equity. So let's get the beta. And the beta is the volatility of the stock. And they have a really low beta, 0.49. And the cost of equity, we calculate that using the CAPM model, capital asset pricing model, and that's 6% versus cost of debt of 3.7%. So the reason equity is more expensive than debt because it's riskier, and in the event of default, equity holders get paid after debt holders if there's any money left over. So the WACC, the weighted average cost of capital, is a blend of the equity and the debt, and that's 5.33%. That's a really low WACC, and that's what we're going to use to discount the future cash flows by. So we estimated future cash flows from our model, and then we discounted those values back to today, and we have a value of the company of $268 billion, and we divide that by 4.1 billion shares. We get an intrinsic stock price of $65, and it's trading at 57, so it is trading at a 12% discount, so it's a buy according to the model. And it looks like it might have been trading around intrinsic value a few months ago, and now it's trading a little bit of a discount. So stocks could definitely trade higher or lower than intrinsic value. It depends how people feel about the future of the company. If more people think the future is bright and they'll be profitable, then the they'll buy the stock and the price will go higher and higher. But if people don't see the value of the company in the future, they're more likely to sell the stock and the price will go lower and lower. So this is my model and my opinion on the stock. And let me know if you have an opinion on this stock, and leave a comment and let me know if you want to do another video. Thanks for watching.